Today, we have a very special guest in our Insights series. I have with me Anil Ghelani from DSP Mutual Fund. Anil has been with DSP Group right from 2003. He's sort of a career veteran at DSP. He has about 20 plus years of experience, and he served as the CEO and Chief Investment Officer at DSP Pension Fund Managers earlier. Right now, Anil manages or is the head of passive investment products at DSP Mutual Fund. Anil, thanks again for joining and talking to us.
Hi, it's great to be with you guys here at AlphaStreet. Thanks for having me here.
Great. Anil, let's sort of start with your personal journey before we get into the stock specific or fund specific question. So we know from your profile that you are a CFA holder, you're also a chartered accountant. Sort of tell us your life journey and how finance became something of interest to you.
Earlier in my career, while I was a young professional, I was very fascinated with the way in which logic and science and numbers work in interplay with each other. So I was naturally drawn towards a career which was relating to numbers, financing, accounting. So I'm a chartered accountant first by background education. And along with that profile, I got a lot of understanding about company balance sheets, business environment in which companies are operating. So I was into like auditing business, like auditing practice rather. So after I finished my CA, I was into auditing, and it was a great experience. I was working with one of the big five in those days, in today's world, what we call as big four, large auditing firms. And sometime during that career, I decided to make a career shift. There was a specific event which happened in the global markets. Many of you might be aware. There was an Enron collapse. And what happened at that point of time, that the company who was once upon a time one of the largest listed entity in the US market, it suddenly collapsed, and they said that they were involved in some accounting fraud or accounting irregularities. And the auditor of that particular company, they had to suddenly get fired. That person had to go to jail, and that overall business suffered significantly. And sitting here in India as a young professional in that field, I was thinking to myself that maybe this is some type of area which I will not be able to do very well in. So I decided to change my course. And at that point of time, asset management as a segment of the industry was very recently opened up for private sector. In 1996-97 was when first private sector mutual funds were initially set up. So I thought that maybe it will be good to grow with a growing type of industry. So I shifted into the asset management industry. I at that time joined a company which is today not in existence, ILNFS Mutual Fund. I was there for a short time, and then I joined DSP Mutual Fund. And why I'm describing this is that sometimes people want to understand how career shifts or career progression happens. So I'm just highlighting this to especially discuss with younger professionals that very often you can get such opportunities for career pivot. So from auditing, I joined into asset management. Within asset management, I was being in accounting and auditing background. I joined fund administration or fund accounting in the mutual fund division. It's not that suddenly I came in and I started managing funds or doing research analysis. Then gradually from that, some expertise is gained, some extra knowledge enhancement was achieved. I pursued my CFA program, got that additional knowledge enhancement and qualification, which gradually led me to some other role. So sometimes it's a way in which you need to work towards some of the goals and try to take different paths. Sometimes don't be hesitant to take a career pivot. So that is broadly how my professional journey has been.
That's very insightful, and I'm sure it's going to be very helpful for all our audience, especially youngsters, looking at jumping into the fund managing. So Anil is a great example. He has grown. He has seen all the back office, front office, you call it, and right now he's managing funds. So you have been part of the mutual fund industry right from the time, as you said, privatization happened. Other than UTI, we had all these foreign funds as well as Indian banks setting up mutual funds. sort of some insights you have on what sort of investors did you had earlier, and what kind of change has happened in the investing landscape in general. If you can throw some light on that, that'll be excellent.
See, I think to a great extent, you mentioned correctly that, of course, there were some so-called, asset management industry in India since like 1960s, like Unit Trust of India, as you said very rightly, was there. And then gradually it started up for private sector. So in the early days, like, the mutual fund industry had a lot of, knowledge enhancement which was going on. People were getting to know about mutual funds. So whenever initial meetings used to be done by salespeople, it would be starting with what is a mutual fund, it's a pooled vehicle, etc., etc. At that point of time, structurally, the largest quantum of funds as well as the number of investors used to be corporate investors, or let's say treasuries, large companies. If I fast forward to today, like now today, you don't really need to speak about what is a mutual fund. You really discuss about what strategy and how it aligns with your overall portfolio allocation. Like let's say in early 2000s, people were not even yet familiar with this kind of concepts. So over the period of about 2 decades or beyond, this kind of constant knowledge enhancements by everybody, by platforms like AlphaStreet, by various asset managers or fund management companies like ours, by various distribution partners, financial advisors, as well as by industry bodies and regulators. The awareness has been significantly enhanced. But I always keep telling to my colleagues in the company or even outside in the industry that today we are still very nascent yet, I feel. Fine, okay, we can say that, okay, we are about 37 to 38 lakh, 40 lakh crore industry. But if you look at it in terms of the penetration, just highlighting some data points, today we have about 2.5 crore unique investors in mutual funds. That is very small. So like I keep telling, like how in Amitabh Bachchan's famous show, आपका ये पहला पड़ाव आ गया है. Okay, we have reached till this stage. अभी आपकी अपना अगला पड़ाव जो है, like the next milestone is like today, last year's, if you look at the number of individuals who have filed the income tax return, something like 6.5 to 7 crores, something like that. It means approximately 7 crore individuals have filed their income tax return. Means they are having a salary of minimum, let's say, some amount, and they are disclosing that salary and filing income tax return. So can we not approach to each of those set of people, start investing something for your long-term future, for your some financial goals? May it be even 5,000, 10,000, 1,000 rupees, gradual SIP you started, but start investing. So that is our first next milestone. And last one point, sorry, I'm digressing to numbers because this is a very important area to discuss. The second number is, let's say, for example, these are statistics available pan-India, in terms of penetration of different, let's say, two-wheelers, let's say air conditioners, let's say cars, So like that, a lot of data is available. So I just picked up on one particular data, let's say penetration of two-wheelers. So there is about 11% penetration of two-wheelers, or whatever you call scooters, motorcycles, nowadays electronic vehicles. And as per the regulation in India, each vehicle on the street has to have compulsory general insurance. Means insurance has to be there. Means those people are compulsorily so-called financially involved. They are logging in every year, selecting some insurance product and buying it for their scooter or bike. And they are having some revenue, right? They are filling petrol, they are maintaining their bike. So can we not approach them? Okay, you start at least with 500 rupee monthly SIP, equivalent to, let's say, one time your fuel tank being filled in your bike. But that will help you in your long-term financial planning and creating a wealth for yourself or for your family. So right now, I feel that we are still at a very early stage, though EUM is rising. Gradually, we need to increase the number of people also participating. And maybe to start with, some of these investors can get initially onboarded with simple low-cost products like ETFs and index funds, or what you mentioned, what I am doing currently in terms of managing passive investments. Where you don't need to really highlight that this is a particular thematic fund, or in this fund manager went overweight on some sector and hence it is underperforming. Don't worry about that. You are broadly tracking the Indian economy and seeing where the broad capital markets are moving. Your fund has moved and given you return and risk in similar characters, in similar fashion. So that is how I feel is the next maybe 1 or 2 decades of this industry, huge potential for penetration to be increased, large number of Indian investors to get on board.
That's an interesting point that you raised, Anil. I know 20 years back when we used to say mutual fund, wo kya hota hai, right?
Yeah,
No, what is that?
yeah,
Stocks?
exactly.
Oh no, that's like bazi, it's gambling. We don't know.
Yeah,
Today,
absolutely.
today thanks to advertisements from Amphi and all, mutual fund sahi hai. But like you said, when it comes to indexing or passive investing, wo kya hota hai? Right. So I think we are at very early stages of indexing trend in India, and I'm glad that you are focusing on that at DSP with a lot of funds. Indexing is definitely something that's not expensive from a cost point of view, but also you don't have to worry about how you're performing your stocks. You don't have to look at the portfolio every day. John Bogley, probably did it best back in the 60s or 70s with Vanguard. Do you see a Vanguard moment in India coming soon, where most of the funds look at this seriously and look at coming out with more indexes outside of the top 100 companies and stuff?
Structurally, I would feel we are already seeing quite a large number of funds which are being introduced. We don't have like just focus only on top 100 like Nifty 50 or Nifty Next 50. Like very recently, we at DSP also, we came out with a fund focused on mid caps. Let's say about 10 years back, even I was a very strong proponent that in mid cap, small cap, don't do passive, because you need a little bit pulse on ground connect, company to company management meeting, etc. But gradually, as the things are changing on ground, as the way in which more and more sophisticated methods of tracking financial reporting and data points and absorbing the data points and churning it and using it for your analysis and your benefits are increasing, I feel that we will be able to reach this kind of a passive investing, rule-based, bond-based, factor-based investing. So let's say one way is the purest form of doing passive investing is that buy the whole market. When you say you want to buy the whole market, suppose you buy, let's say, the top 100 companies, as you said, you are covered with broadly about like 75 to 80% of the entire market cap, and you are sorted basically, okay, as a basic allocation to equities. So what we suggest to investors, or based on their risk and return profile, that maybe some allocation of your equity can be to this core equity, which will be in the top 100 companies. Buy one or two index fund or ETF and pack your that allocation. Then for the balance, like sort of satellite allocation, you take some exposure, maybe sometime it can be tactical to some particular sector ETF, or it can be to some actively managed very small cap kind of a fund, going down even below mid caps. See, mid caps today in our Indian context still have like a size of about 10-12,000 crore. Today, like this fund which I mentioned, the DSP family, one vehicle, one ETF we launched. In that, we have close to about 20 to 25,000 crore as an average market cap size, which is quite large. I mean, it's not some like very small cap. But in small caps, which are ranked number 251 and beyond, there I still feel we are still early to go fully passive, and one can continue to have active management over there. So I feel that in some way, the so-called alignment towards passive funds like index funds and ETFs have started already. Today, as we speak, we have close to about 4 lakh crores of ETFs and about 50,000 crores of index funds. So 4 lakh 50,000 crores of passively managed funds out of total industry size of approximately 38, 39 lakhs, 40 lakhs approximately. So around 11% of the total mutual fund industry in India is now passively managed, which is broadly in line today with global trends. Globally also it is about 10%. Now, what I believe that by 2025 means another 3 to 4 years from now, 3 years now from now approximately, and not just my belief, but what we have read in many global consultant reports is that the entire asset management industry, like how I said in India we have 40 lakh crore, like that if you capture what is there in Japan, in UK, in US, that entire pool of money, which is like professionally managed assets, is approximately $102 trillion, roughly about thereabouts. Latest data I don't have, but this is like previous year-end number. Of that, about 10% is passive funds. And by 2025, it is expected to grow to about 150 trillion. So large growth. And ETF and index funds or the passive block will become about 25 to 30% of it. So from the current scale, it will probably be one of the biggest driver for enhancing the participation and penetration of professionally managed money like mutual funds, PMS, that way. So I feel it's a very interesting time right now, and like what you're saying, that moment has already come. We are in that already, and not just India but world over. We will see this trend where we are currently about thereabouts of 10%, and it will possibly grow to about, let's say, 25 to 30%, depending on whichever consultants report you believe. But I feel definitely about 20 to 25% in India, it's very easily achievable.
Excellent. Oh, I actually, I'm myself surprised. I didn't realize that this, 11% of penetration for passive in India.
Very large. Very large.
So that's a stat that even I'm surprised, because, back of your mind, you still think passive is too early in India, not many.
Yeah.
So, and you mentioned briefly about, you launching a mid-cap, index ETF. Can you briefly touch upon, what are the highlights of it, and what investors should be aware of, those who are already into passive but sticking to Nifty 50, Nifty Next 50? What does mid-cap offer?
Sure. See, structurally, I'll just highlight one thing that, when you look at your overall asset allocation, some component can be very useful to having mid-cap stocks as well. Structurally, if you see from a long-term perspective, if I look at, let's say, Nifty 50 returns, and I look at, let's say, Nifty Midcap 150, which is a broad universe of 150 stocks. Today midcaps are defined as rank number 101 to 251. So a block of about 150 stocks. So historically, I'm saying from about, let's say, 2005, where the data is available, means about 15 odd years, the Nifty 50, the TRI, the total return index, would have given about a 15.5% CAGR returns, and the midcap 150, that is a block of midcap securities, would have given about 17.5, so approximately 2% higher return. But with high risk return potential, the risk is also relatively higher. So when we have seen some drawdowns, like during 2008 global financial crisis, Nifty 50 fell by about 59%, and Nifty Midcap 150, it fell by approximately 72%. Likewise, in the pandemic crisis, at the start of the crisis in February of 2020, March of 2020, Nifty 50 fell about from the peak till the bottom. It was down about 38%, and Nifty Midcap 150, the overall universe of midcap stocks, was down about 43%. So it's a large drawdown also, which one has to be ready to accept, with the potential of getting that upside also. So what we did is that as I was saying, in the passively managed, we wanted to apply certain filters before we select entire universe of mid-cap stocks, because that could be a little bit difficult, So we said that, okay, when we are looking at mid-caps, the first and foremost thing you want to see is quality. There should be good quality companies. The rest of it, like momentum, growth, value, that can follow. Just on the lighter side, I'll digress a little bit. Let's say if I was to invite you, okay, sir, things are reopening. Next time you are this side of town, let's have lunch together. Come to my office. I'm at Nariman Point, right? So I said, Nariman Point, Anil bhai yaad aata hai, bahut pehle mein aata tha, and we used to have street food. It was fun. So you take me for street food. So now when I have to take you for street food, I have to be very careful of the quality of the food first. You should not fall sick. Nariman Point, Anil bhai lunch lege gaye, main bimar pad gaya. So I will focus on my attention that, okay, there's a line of street food vendors. Out of that 3 or 4 vendors, I have always seen that they carry those big plastic distillery bottles are coming. The others have that some free flowing water. So we'll go there. First, quality is taken care of. Then whether you want Chinese, one of the one of the stall will Chinese, one will have some South Indian, whatever is your choice, you pick it up. But first and foremost, quality I have focused on. Likewise, mind you, hence I said street food. Suppose if you come say, okay, I want to have some good meal, I'll take you to either Opera or Trident or Taj. Then so-called connector with a large cap. Then I don't have to worry about the quality. I'll directly focus this time. Italian person, Indian person, I'll go to that restaurant, matter over. But in mid-cap, first focus on quality, then taste, cuisine, Indian, Chinese, whatever, that is separate. So likewise, in mid-cap, we said quality is the base. So when we launched this ETF with focus on mid-cap, we did it with the quality focus. So the index that is being used is Nifty Midcap 150 Quality 50. So from those 150 mid-cap stocks, which is a broader universe, only the good quality stocks are picked up. So like I was saying, the number, like from that historical period, Nifty 50 has about 15% return, Nifty Midcap 150 has about 17% return, right? CAGR, so about 2% higher. And Midcap Quality 50 Index, the Nifty Midcap 150 Quality 50 Index, that is given in that same period CAGR of about 21%. So even better upside. But yes, no doubt, again, as I said, being midcap, there will be certain periods where it has even underperformed the broader universe of midcaps, like what we had seen very recently in the period of 2020 after the upcycle started. That time, people were not focused only on quality. Everything was riding. It was a broad-based rally. So in fact, more than the quality, good quality stocks, everything was rising. So at that point of time, midcap quality index suffered and it was underperformer. So there will be certain such periods where it will underperform, but over longer periods of time, what we have seen in the history, it has done much better, and you feel much more comfortable in owning quality stocks in the mid-cap space. So that is how we have tried to position our this mid-cap offering in the passive space. That okay, come, feel free. I mean, I will take you for lunch. We will go to the roadside food, but I will take you only to those 5-7 roadside stalls which I know at least will serve good quality ingredients. Then taste and all is secondary. You don't worry about that. I mean, by and large, we feel that will be serving you in a good way only.
That's a great analogy and anecdote to use. Anil bhai, I'm going to hold you to that promise. Next time I visit you, I'm definitely you have to take me to a nice street food joint. So using the same, it cannot be just fill it, forget, and shut it. Zara sambal ke, right? Great. Sticking to the indexing here. Now, as an investor, right? I am presented with multiple funds, multiple choices, Nifty 50. What are some of the criteria that I need to do? So expense ratio is something that I think most investors are aware of, but often what doesn't get mentioned is the tracking error, right? Is there anything else that an investor should filter before deciding on which fund to pick up and which index to invest in?
I think that's a good point. See, I think to a great extent, yes, expense ratio is important, but by and large, I would say by and large, all the funds which are in that category are all low cost funds. Everybody's expense ratio is like plus minus few basis points. Okay, so let's say unless you are advising a large corporate or you are running a large treasury and you want to allocate large chunks of money for your tactical allocation, there you can say, okay, even if 10 basis point, 5 basis point cost differential is very relevant and important for me. But if you are, let's say, allocating for a long-term overall asset allocation, then that 2-5 basis point cost will not be too much of a difference. Cost is important. I'm not saying that, but not to a very great extent. So you have to go with the assumption that by and large, all asset managers, they are also tracking the cost of the competitors and it's broadly in line. So, but yes, as an investor or as an analyst or advisor suggesting investors, one should definitely look at the expense ratio. That is very crucial. The other part you mentioned, like for example, let's say tracking error. Now, in my view, tracking error is important, no doubt. For me as a manager and my team, every day it's a daily number we track very closely because of our tracking error, comparative tracking error, everything. But for a retail investor or like a HNI investor, it's a statistical measure. It's like a scientist number. It's like saying, okay, we went to that street food joint, and now from there we are saying, okay, what is the source of the potato that you have got, and whether that potato was, produced using some what type of soil. It's like that. What I mean by that is, what is the formula of tracking error? Tracking error is in simply put way, it is a standard deviation of the daily dispersion of your return versus the benchmark return. Now, while speaking, I can explain to you and spoke to you. If you have to write the formula, so maybe shall लिख नहीं पाऊंगा. Excel में calculate we do it, but it's like sigma of like x by x bar divided by like, I mean, sorry, I don't mean it in literal way, but it's a difficult formula to calculate, and it needs minimum of, as a best practice, at least 3 years data for the data set and the analysis to be relevant. So you are looking at actually 3-year data and calculating the daily dispersion and then trying to come to some conclusion. Oh, this fund has a lower tracking error, this fund has a higher tracking error. Fine, okay, it's important, you should do it. But otherwise, by and large, you should go ahead with the overall comfort of the house, overall comfort of how that particular fund has been operating in the past. Look at certain other aspects like soft aspects, like see, when you go to buy or sell that fund, whether what kind of comfort you get, whether there's an online digital way to enter or exit. Just example I'm saying, it's like, to be very honest, it's like saying, sir or madam, where you have your salary account? You'll say, oh, well, I have it in Kotak Mahindra. Somebody say, I have it in ICICI Bank. Somebody ABC. Oh, why you have in Kotak, sir? Why not in ICICI? Well, because no reason. In my office building, there is an ATM. But itna reason ho sakta hai. Because all other things are broadly similar. I'll get a ATM card to withdraw money. I'll get a checkbook facility. I'll get a credit card, whatever. So what? Just like that. Somebody can say, no, I like to invest only in DSP funds. Why? Because I know there is a dedicated investment team. Anil, you are there, and you have a team who is dedicated only for ETF. I feel comfortable. Okay, thank you very much. Somebody will say, no, I prefer XYZ house ETF or index fund. Why? Because their office is right opposite my grandfather's house in Kanpur. Well, sorry, I don't have my office over there. Okay, so ab udhar invest kar lijiye. What I mean is that some of the softer aspects also are very important. More than these kind of statistical measures, which are also relevant. TR, yes, total expense ratio, you should see. And later on, if you have time, I'll also try to cover another very interesting point over here, that in normal mutual funds, we look at TER. In the ETFs, we should look at TCO. So TER is, as a concept, everybody is familiar with the total expense ratio. TCO is something different, which is the total cost of ownership. So total cost of ownership, what it does is it calculates the TER plus all the other explicit and implicit costs attached, especially for ETFs. Because see, when you are buying ETF, you have to buy it on the exchange. There will be a broker involved. Some small brokerage will be paid. There will be GST on the brokerage. You will hold the ETF in a demat account. Small demat cost will be put, annual cost. It will be all small costs. But today, when a TER of a ETF, let's say Nifty 50 ETF, like there is a Nifty 50 ETF we run, we charge a TER of 7 basis points. So in that, if you add up all those small, the TCO might come to, let's say, 12-15 basis points. But it's important, each of those 1-2 basis points add up. So as an investor and as an advisor suggesting to your clients, you should try to start enlightening and focusing on TCO, total cost of ownership. So world over, whenever you're looking at ETFs, typically people look at TCO as a concept rather than TER. In normal mutual funds or even index funds, yes, TER is perfect because that is what number you see and that is the actual cost year on year which you are paying. But over here, TCO is a useful concept you have to look at. So look at TCO, look at your tracking error, look at various other parameters like the softer aspects of the fund house, the comfort that you derive, the pedigree of the fund house, and based on that, just go ahead with the decision. Because broadly, your strategy is fixed. That okay, I want to go passive. I want to buy broader market, keep my core allocation, or I want to do some factor investing or some mid-cap investing with low cost. Yes, go for it.
And stick to the asset allocation.
And stick to the asset allocation. That's the more crucial part. Yeah.
Great example. And TCO, I'm sure not many of us would have heard about TCO and broader in the ETF space. So great insight. Thanks, Anil. Let's shift gears a little bit. Let's talk about the elephant in the room here, sort of, the geopolitics, or what's happening around. A lot of investors in our community, we constantly get messages because they see their portfolio going down. What should I do? Should I sell? Should I stick to it? So most of us are aware of the seen issues, but what are the unseen benefits or unseen issues that can come up from your perspective, sort of your mental models on the geographic upheaval, and what from an investor's point of view should I or anyone listening to this should be aware of?
I think whenever there is this kind of a geopolitical tension which leads to some kind of a physical on-ground conflict, it's very challenging, very upsetting. To be very honest, personally, I never expected such kind of a outcome of whatever the geopolitical tension was building up. It's very unfortunate, and we all hope and pray it will resolve very fast. But from the point of view of capital markets, one needs to be very alert and very careful. See, there will be multiple areas where this will have an impact. Some of it will be direct impact to us, some will be indirect impact, which we'll see later on. So direct impact will be, let's say, for example, what we are seeing in terms of the effect on commodities, the way in which we are seeing crude oil rising sharply, crossing like crossing $100 also was a very big deal. We had not expected, like, let's say 6 months back, this kind of numbers, or crossing now, let's say, even 10% beyond that, $110. It's like something very alarming. And all other commodities, as those commodities rise, the immediate impact will be on the raw material or the input cost of the various businesses, various manufacturing setup. And in that time, in fact, the impact will come on the inflation. So as we start seeing this kind of a multiple layer of impact, one will have to be very cautious in terms of how the policymakers will react, what will the impact be on the fiscal policy and monetary policy. Now, today, we are not in a position where central banks and central governments are sitting with their powder dry to take care of many things. Of course, they are sitting with a very strong vision and very strong foresight and managing everything in a very prudent manner. Only thing is that they have been managing another crisis since the past about 20 to 24 months, which is a pandemic crisis. World over, all central banks and central governments from somewhere during March of 2020 have been doing coordinated efforts, both central government and central banks. Central government fiscal stimulus, central banks monetary stimulus. And that has been going on. And in fact, very recently now, many of them have started thinking of ways of gradually reducing them. So now suddenly, if there is another demand that one needs to enhance the stimulus, it's going to be a little bit delicate situation how and what all measures will be used. So which is very interesting, one needs to watch out for and try to keep a very close judgment on that, because one area will lead to disbalance in the other. Suppose if there is a way in which some kind of fiscal stimulus were to continue, then there will be some kind of a disbalance. What will happen when the fiscal deficit goes up? There will be higher borrowing, so that will impact your monetary policy, the central bankers area. So it's very sensitive. One needs to watch it very carefully. I will try to summarize and close out this point with another very interesting observation or number crunching analysis that we are doing. Very unfortunate situation, but this particular country, which is under the spotlight right now, is Russia and Ukraine. Now, if you go back, like I'm remembering, like what we were discussing early days of my career, in 2000, early 2000, there was a terminology which was coined as BRIC. Very often, nowadays people might have almost started forgetting it, but it was Brazil, Russia, India, and China, the so-called 4 countries, which at that point of time were perceived that there was a very popular person, Jim O'Neill, used that, and he came up with this in some paper that this will be the fastest growing global economies, and it was very true. From the share of about 10% of the global GDP, these 4 countries by 2010, means about like that 10-15 years later on, were close to about 30% like of the share of global GDP. So they were very fast growing countries. And now what happened gradually, a lot of funds, since we are talking about passive funds and ETFs, I'd like to just highlight this aspect because it's very much important to track how it will impact global flows. So there were many BRIC funds which got launched, BRIC ETFs, BRIC index funds, which had large exposure to these 4 countries. On hindsight, little bit fortunate that at last decade, they lost a little bit charm that instead of BRIC, let's expand a little bit and make it emerging market product, not just BRIC countries, larger economies. So many of those BRIC ETFs got either closed or they converted into emerging market ETFs, which has many more countries. As of now, there are only 2 or 3 BRIC ETFs left, small area, maybe 250, 300 million, which is good. But now this emerging market ETFs, there is close to about last week we were seeing is close to about $950 billion. $900 to $950 billion worth of ETFs are running on emerging markets. Now, emerging markets include exposure to India, Russia, various countries, in the emerging market space. Now, 950 billion, like as I was saying, if you look at it in context from Indian markets, almost 2 times the entire mutual fund industry we just spoke about, right? Indian mutual fund industry about 40 lakh crore, and this is like almost 2 times of that by about, in terms of dollar billion. So, if now, as the trend is changing, that all of these indices will soon eliminate Russia exposure from their inclusion, because Russia market is now no longer accessible for foreign investors to buy new shares or sell shares, technically trading into their Russian country. So the weightage of Russia, which is close to about 2.5 to 3%, will suddenly have to get taken out. So what will happen is that this entire 3% of the money which is invested into these securities will get realigned to other markets, which includes India, China, Taiwan, wherever. So India will see expected approximately $1.8 to $2 billion worth of fresh flows, because all these emerging market ETFs will have to do rebalancing their portfolios and increase the weight of India and reduce the weight of the other. I mean, proportionately, I mean, change that. I mean, no doubt today's world, I mean, in Indian context, $2 billion is not a very big flow. I mean, from foreigners, it's quite okay, it will come in. But just I'm trying to highlight that these are some of the ways in which there will be a impact on how the foreign investors, especially the passive funds and ETFs, will be taking their investment decisions based on this current situation that is emerging.
That's a great insight that, I'm sure none of us would have thought about, the break and, the fallout of the emerging market. So thanks for that. This is a developing situation. So
it's developing, very sensitive, and yeah, sometimes very difficult to go into second layer of depth of which stocks or which sectors or how it will impact. But I think I like one of the things you said earlier, that once you have, as an investor, consulted your advisor and planned your life goals, aligned your financial goals to them, and decided some asset allocation, then don't worry about such issues and events. Of course, you have to be alert and review, but otherwise, broadly, by and large, stick to your asset allocation. That should be the important thing as a takeaway. I'm not saying just sit and do nothing. Keep alert, keep a watch on it. If need be, do a little bit tweak if it's misaligned with your goal. But otherwise, try to by and large stick to your asset allocation.
That's a great point. If you're in your 20s and 30s and your life goals are still far away, stick to your guns. Stick to your guns at this point. Literally, quite literally. Let's try to understand you a little bit more. So, Anil pre-COVID and Anil post-COVID. What are some of the life lessons that you learned? If you can just briefly touch on
life lessons. Well. Well, of course, one of the main life lessons everybody learned was that health is the true wealth. One needs to be very, very careful about health. So for me personally, I have done one slight tweak in my daily life routine. Many of friends who might be knowing me or have seen me or met me before, I have lost a little bit weight. I have always been on the lean side, so not much to lose. People will be laughing maybe. But some of the so-called bad weight, like I had a habit of having 4 or 5 cups of tea in the office. It's a natural thing. I mean, so I have no other thing like zero alcohol, zero tobacco, but tea is one of my big points. And when you are in the office and we have a nice cafeteria, or whenever, even if because of people knowing that they know, okay, if Anil is coming to my office, I need to make sure there is some good tea available. But that increases your sugar intake, various other things. So in a way, during the lockdown, well, offices and all were shut. External meetings were shut. By default, it came in control. So now I maintained that. So now that is one good thing. Connecting to the original point, what I said is that health is a true wealth. One needs to be very careful of that. The second and the important part, which is there, is about how you coming to the world of investing and financing and personal finance, is about how you need to plan for such kind of instances. Now, I mean, it's a cliche dialogue if I say, yeah, you should keep some safe money, everything. In the last 2 years, everybody and anybody has spoken about it and read it in newspapers. So fine, I appreciate that. I just want to highlight one thing which I found a little bit, from my experience, is that especially for many of us friends who are in salaried roles, for me also, I've been a salaried employee since the beginning of my career. So I always used to feel that my company is there and taking good care in terms of very, very prudent and very good insurance policy in terms of health and life cover, which is great, no doubt. So very often one tends to ignore buying separate cover, like a term cover or a medical insurance cover. I'm not saying everybody should start running and immediately going and buying it, but I urge you to do one review of it once with your trusted advisor or your family friend or whatever, and review some of that. It's very important. Because no matter how much well planned you are with your employers, a medical policy or life policy, some bit of additional personal policy is very important, especially if you are going to be in a place where you change your job, or if you at some stage move into an entrepreneurial role. I strongly feel I had personally underestimated the need and the power of this. Though I mean a little bit embarrassing while speaking, I'm realizing as a financial professional, but I should have been also aware and doing this much more in advance. But doesn't matter. That is one important learning I would like to share with everybody.
So we all ask this question at the end of our interview.
Okay.
Recommend 3 books for our listeners from your personal collection, or the ones that is top of your mind.
Sure. So in fact, good point. I'll highlight one particular book which is top of mind. A very new book. In fact, I have just also recently called for it. It's called Gorillas Can Dance. So Gorillas Can Dance is about how large corporations, who especially in the big tech space, like recently all these FANG and FANGMANGs and different terminologies which had got coined, they can be defined as so-called gorillas. There is this author called Shamin Prashantam, or I don't know pronunciation, Prashantam. He has written this book, and it's about the interplay between this kind of large so-called gorillas and the various startups. Like today, if you think of Microsoft as a large startup, and some of the various, the large gorilla, and some of the smaller startups who are maybe using some or the other part of Microsoft and then trying to do something very disruptive or very different. So how at one point of time, all of these gorillas were also small startups, but now they have to be careful of this also. So it's a good book in terms of the interplay between these two, and how the gorillas also have to be nimble, agile. It's a very recent book, so I also just read about it, and I'm planning to read it. So I urge you, your listeners, to try and get a hand on it. One more is, so this is not about anything about specific asset management or finance or whatever. I'll come to that also in a minute. But this and another book called Small Actions. The Small Actions is a book by an author, Eric Sim. Eric Sim is also very known person to me, and he has one of the largest following on LinkedIn. Like he has got some 3 million followers on LinkedIn. Amazing. I can't even think of that kind of a following. And he's written this book from his practical experiences, that how he was earlier a street food vendor, and from there he was a MD in one or two of the large global investment banks, and then now he is doing his own entrepreneurial journey and an author and trainer and all like that. Okay? So from his journey and learnings of small actions, like how some small actions can lead to certain big career changes. Very interesting book. I've read it, and in fact I urge you, everybody to try. Again, recently it has come out, and soon it is going to be launched in paperback edition in India also. Right now it's available online. Another very interesting book, because it's the third one. This is about capital markets and learning. It's called Trend Following. Slightly old book. Many of you might have already read it, but it's a very good book. Michael Cowell is the author. Trend Following is a very nice book, and where in certain way it's a way how friends in developing markets like India, one of the main factor which always works well is momentum, or in that sense like trend follower. If you can either be a trend follower or a believer in reversion to mean. So this book highlights how this kind of trend following investment strategies can be beneficial, which can enable you, or of course not enable, but which can guide you one of the alternative to make money in bear market, bull market, and black swan market. Others people say, bear market even also is that I can make money. Bull market also, I can make money. But sudden black swan type event and all, not very easy. But some of these elements which he has outlined is very useful. So I urge you try and read it. So this is the three books. I'll take 30 seconds more. Very interesting one book, not about this finance or learning and all. Sometimes I also personally like to read fiction books. Story book bolte hain, jo bachpan mein padhte the waise type ka. So there is this book I read recently. It's called Heads You Win. It is by this very famous author Jeffrey Archer. बहुत common, बहुत popular author है. काफी लोगों ने पढ़ा है. So Heads You Win was I think little bit old, but I pulled out from somewhere and read it. It was published in 2018, almost 4 or 5 years back. And it rewinds back 50 years ago from 1968. And it talks about in that period, there was Leningrad, which is a city in Russia, how the hero of the story, or like whatever the main one of the character, was in Leningrad in Russia, and how the interplay between Russia and some other countries, and how they show about that story. Then later on, he grows up into like a very interesting twist and turn from Russia to US and UK, and very interesting way in which the entire time history of Russia in 60s, then in the 90s, then like how after the Soviet Union changed its structure. Of course, nothing directly connected to the current escalation and the war, the situation, but something unique it brings to light, which is technically fictional because author has taken liberty to write as a storybook. But some of the things is factual. Ye city aisi thi, this was the port, this was this, like broadly. It is very interesting. I found it useful. I mean, it's a fun reading. If somebody is fond of reading, you can try it. Basically,
Great.
Heads you win.
Yeah. Heads you win from Jeffrey Archer. Great set of recommendations. We asked for 3, you gave us 4. Thanks, Anil Bhai. We have a request from some of my followers on Twitter. This is my last question. So, a lot of our audience subscribers are youngsters, pursuing their finance, CFAs or C. They want to know what's a typical day of a fund manager. How big is your team? What do you do on a daily basis? These are for aspirants, and I believe you are pretty active in CFA India Society also. So, any tips for youngsters would be greatly appreciated.
Sure. So, see, no, you're right, absolutely. So, I'm a volunteer with CFA Society India since the past more than 12-15 years, and it's very interesting. We try to engage with a lot of people and create a platform for networking, engaging, knowledge enhancement, and career progression. In terms of how my day or day of a portfolio manager or fund manager would be like, structurally, you need to be very alert and you need to be very aware of how your surrounding is changing. So, like as I mentioned, you need to be constantly thinking that, okay, what if something X is happening in some country or in some jurisdiction or in some segment, how it can directly or indirectly impact your portfolio or your companies, or how it can impact people's reaction to it, or how it can impact some particular policy making decision. So you need to be constantly thinking and trying to connect dots. Sometimes just sitting in the blank. For some people it can be very interesting. For some people it can sound very good, but when you actually sit on it, it might not be good. So I have met with many young professionals who feel that this is a very aspirational thing. I want to be a fund manager. I want to be a research analyst. And some people say, okay, now I got this opportunity, and when I sit on my desk, like my team, I just this is my dealing room just across the glass cabin, and so there's one Reuters terminal, one Bloomberg terminal, and we're tracking markets, we're tracking your portfolios. Not in my team, but just example, I'm saying that particular person whom I'm referring to. So she said, I'm sorry, but I'm just not able to, when I'm sitting in front of the screen during the day, मेरे को थोड़ा टाइम में चक्कर आने लगता है नंबर देखते देखते, मेरे को नहीं चल रहा है, मेरे को और कुछ रोल दिखाए सर. So sometimes one needs to be very careful in deciding your career path. Don't go by what you are hearing of some other people, but be very careful. Make your own decision tree. Make sure you try to fine tune that 10 years later, what your role will be like and what the world will be like. So I always tell people that look at, let's say, the future 2030. Then try to see that what type of role will be there and what you feel like doing in that. Only then you go for that career. Otherwise, don't. So typical day is like very sometimes relaxed. Sometimes very hectic. So like for example, today my day was very hectic because just after the market shut, we had this session. Just during the day, a lot of volatility with some news flow was coming. At some point of time, you need to be a little bit, on the edge of your seat. Sometimes you end up having a relaxed day, so you're having lunch with your team. Today, I don't know whether this is live or this will play later on, but on 4th of March is like what we call as World Appreciation Day. So from morning, many people were just dropping a line or coming to wish in person that, today's appreciation day and it's been great working with you. Or so like that, suddenly in the morning, the day started with a very light and a fun day. Somebody sent some chocolate, I sent my team members some small note. And then by afternoon, suddenly we are struggling and hardly I got time to grab a quick lunch and then back at my desk and so it's a very dynamic day. But as I said in the beginning, as long as you are passionate about that, you feel that, okay, by doing this, it's not that I'm doing this job for my personal goal or my personal satisfaction. Of course, that is there. But if you are aligned with this, that by doing my job, when I hit my desk in the morning and when I leave in the night, even if I have a rough day, I want to come back fast next day because what I'm doing is going to make a difference to a large set of 30 lakh investors who are investing with my fund or with my fund house or whatever I'm just saying. And it is, my action is in some small way helping that individual or that corporate entity to meet its own investment objective or its asset allocation and it move one step closer to their life goal or their financial objective of that company. If that drives me pleasure, then it's the job for you. Then you will not feel upset, you will not feel bad. Even if you have had a rough day at work and you have reached home at middle of the night, at 7 in the morning, you will be up and rushing to the office before 9 and you will be at your desk live and active. So that's the key I would like to highlight, especially for professionals who are going to choose their way. And the last point you said about my team, let's see, in passive investing, structurally, we are amongst the few people who have a dedicated investment team, which is in line with global best practices. At that point of time, we were part of a joint venture with one of the world's largest asset manager. So they had a very clear-cut segregated investment team separate from the investment team which manages the active fund. So we also did it like that. Team is very small, only 3-member team. I'm hiring right now. So my first port of call also, since you mentioned about the CFA, we have a CFA job career portal. So I posted my requirement over there. I'm interviewing people right now. So, a little bit, but small, 1%, 2% we are hiring. So team is very lean, very small team. And, day is very fun, very interesting day. Only if you, as I said, are aligned with what you are doing. Otherwise, they can be very rough, very hectic, very boring, very tiring. People say, oh, I have such a stressful job. We don't know fund manager job. देखो मेरे बाल white हो गए, देखो मेरा ऐसा हो गया, मेरा ये होगा. मेरे को तो दिन में 2 बार नीचे के सिगरेट पीने के लिए चाहिए, नहीं तो stress relief नहीं होता है. अरे वो ऐसा कुछ नहीं होता है, boss. If you're aligned with what you're doing and you're enjoying it, everything is fine. You are enjoying.
Find your purpose in life, and passion is never a job. Perfect.
Exactly.
Perfect.
Exactly.
I appreciate you, since it's World Appreciation Day, for taking the time out of your busy schedule and catching up with us. It was a great session with you, and I look forward to that vada pav when I'm meeting you in person.
Look forward. Thank you. Thank you.
Thank you, Anil bhai.
Okay, thank you. Bye. Good day. Bye.